Dave here. I've been working on my technical analysis skills for a little bit, and I've been trying to because there's quite a bit of anxiety in the market about where gold is going, and I think a lot of people are a little bit anxious that maybe they're going to see lower prices of gold before the end of the year. I'm a little bit anxious, but honestly, I'm not too anxious because because if you're stacking for the long term, you have your physical gold with you, and it's an insurance policy against terrible things. But ultimately, your sell horizon is 30 years, and there's no way of doing technical analysis to predict the price of what it will be in 30 years relative to today, because you just can't because there's too many unknowns between here and 30 years. And what I've been doing, and I'll show you, is I've been working with pretty much some machine learning algorithms to try and do what a lot of these funds have been doing, is that they take a lot of market data and they try to make a prediction for the future based upon known information, market information today. And I showed this in my previous video that I take into consideration for price of gold, silver, crude oil, S&P 500, Russell 2000, 10-year futures note, different metals, dollar volatility index, soybeans, other commodities, different currencies. I took into consideration also cryptocurrencies, different markets, and I also took in the gold spider ETF, which the funny thing about this ETF is that it doesn't actually contain physical gold, but they do have to buy some physical gold to trade to make sure that the price reflects what the physical gold is. So it's more like if there is any relationship, it'll track it. Also, I'm tracking basically the price of insurance. These are two leverage instruments index. And this is sort of the tracking of insurance on the S&P 500. And I'm also tracking the gold miner stocks with this leverage index. It's called the Direction Index, and the financials, the banking sector leverage index. And what I did was, I ran the program. I tried to build two models. I tried to build a 14-day model, which looks at the price of gold and tries to predict the price of gold 14 days from today, and another model that tries to predict the price of gold 112 days. And I'm taking data from a little bit before the end of the crash of the 2008 crisis and going all the way to today. And you're like, yeah, it seems like mumbo jumbo, but essentially how it works is it looks at how gold performed based upon all those market prices and how those prices changed, and it tries to basically guess based upon past prices and the features of those markets what will be the future price, right? If a certain pattern occurred in the past across all those markets, and there was a good fit from the past, and it could make a new price projection for the future of how the price based on today's price will evolve. And that's pretty much what most, I would say, even fundamental analysts do. They look at, for example, they say oh yeah, we're looking at the monetary supply, and then my ticker, I'm taking consideration. So the 10-year note is sort of a proxy for the monetary supply. And typically when the 10-year notes go down and your interest rates go down, monetary supply increases. So that's kind of a proxy for the monetary supply. And when all these factors change, they affect the price of gold differently, some more, some less. Funny thing was, when I was looking at my data, there's some stuff like Bitcoin, which is none of these things should contribute strongly to how gold moves. But Bitcoin seems to, despite having almost 32 different types of data coming in, Bitcoin was contributing at certain times almost 6% of how much gold moves, which means that there's a strong correlation between what goes into pricing of Bitcoin most likely and also what goes into pricing of gold, which is a very interesting relationship because a lot of analysts don't tend to use these two, Bitcoin and also the Crypto 200 index funds, which I don't think the big price of Bitcoin drives the price of gold, but I think that a lot of these Bitcoin and gold, they have a certain like sort of a relationship relative to the overall market that is very similar. So what have I been looking at? Well, I try to make some models and then see if I could extract some information and if I could predict the price of gold. Well, I'm sorry to disappoint you. I did not make a crystal ball that could predict the price of gold. Actually, it is quite hard to predict the price of gold. I will show you. I've extracted all the information and I've put it into a drive. I'll share this file with everybody. I've been testing different types of information going into it. I think the one that takes into consideration the options market is potentially one of the better models. So I've been doing the 14-day projection for the price of gold with taking into consideration the options market and also cryptocurrencies and everything else. And I've gotten a decent reading from it in terms of accuracy and how accurate it predicts the price of gold. And you can see here that, for example, for the recent days of accuracy, I have on average 97%, which isn't bad. You know, it's pretty spot on. It's pretty good. However, there are a few things that I've noticed in the sort of model. So the first thing I've noticed is that, I'll show you the accuracy versus date. The model fails to predict certain things. And one of the things it is unable to predict is external events, right? It cannot look at financial markets and understand external events that cause a change in the price of gold. For example, in March, I would say starting from the end of March, in this March period, it fails spectacularly because I'm plotting the predicted price versus the real price. And it fails spectacularly in March. Why does it fail spectacularly in March? Well, I think it cannot predict what happened in March, which was a shutdown. It could not predict a shutdown. It could predict that before the shutdown, if there was no shutdown and things were going probably like if the market was raging onwards and then interest rates kept going upwards, it can't predict that. It could not predict a shutdown. The second thing it couldn't predict is that it could not predict that the Federal Reserve would step in and perform QE in July. Like, these are two events. It's clear when I plot out the accuracy of the model, right? In general, most cases, it's relatively accurate, right? There are quite a lot of instances where its accuracy isn't too bad and it's above the 90% range. It's not great, but it's not too bad. But there are points, very specific instances where you have strong external events, it's unable to predict it. The way I like to put it is like this. Imagine you are a baseball coach and you have a baseball player and you know that your baseball player is a pretty good pitcher. And you decide to play a game against another team, and this game is 14 days in the future, right? And you decide that your baseball player, he's a pretty good pitcher, and if you have him on the team, you're going to win because he's going to strike out half the other team. And you make your bets 14 days before the game, and you're like 2 days away from the game. Suddenly your pitcher, he gets his hand jammed in the door, he breaks his fingers. And now that's an external event. You knew based upon like the training and what your player eats and everything, how he should normally perform. But because of an external event, him jamming his hand in the door, which you could not predict, suddenly when you go and you play the game, your prediction, your bet is wrong because, well, you don't have your best pitcher. You've got like a terrible pitcher now, and you lose your money making that bet. But was it a smart? Were you smart to bet for your pitcher, who was pretty good and like pretty much eliminates almost every single game, 50% of the other team? Yeah, that was a smart bet based on the market conditions, but you cannot predict future events. And no matter what you use, the further in time you go, the less accurate you are. So if you look at how gold is predicted over a 14-day period, it's relatively accurate. There are some external events that make it inaccurate, and there are some changes in prices that it cannot predict very well. But overall, it is pretty good at predicting the price. But what if you try to extend it further? Let's say you want to make it into a 4-month predictor, right? Can it still work? I did that. I made a model to do a 14-day prediction. And what I noticed is it's, let's see, where did I put that model? Nope, it must be on the very top. Is that when I ran across historical data over just gold target date at 112, it doesn't work very well. The reason why is pretty simple. Like, the model can make a prediction based upon what it knows. It can't make a prediction based upon what it doesn't know. So it doesn't know about government policies. It doesn't know about I don't know, trade wars. It doesn't know about geopolitical affairs. It doesn't know about it doesn't know about viruses. It doesn't know about public health. It doesn't know anything about pandemics, shutdowns, whatever. It doesn't know that there's an election going on, right? It can't know that. It's not in its sort of what it learned. And also I haven't fed it that data. It's very hard to get that type of information. It only knows financial information. So it makes its predictions upon the current known financial market information, which in theory are proxies for all these other external events to price out the price of gold. It fails when you make it a 4-month prediction, and in that 4-month, let's say we start off and we make our prediction sometime in 2019, in the middle of 2019, and the Federal Reserve is hiking interest rates, right? And all of a sudden, somewhere near the middle of 2019, there's people learn that there is a virus going on, so the price of gold is going up. It's priced in that uncertainty. But when we made at the beginning of 2019 our prediction, we were expecting just more interest rate hikes. We couldn't predict an external event, so you've got divergence in sort of your model and the actual price. When all the markets readjust to the external factor, it starts readjusting your model and starts pricing your price upwards and saying oh crap, we priced wrongly. Now that all the markets have realigned, it's going to price correctly again. And then afterwards, you've got shutdowns, you've got all sorts of other things, you've got elections happening. These are all things that I cannot predict. So when you try to throw it's the same analogy as if you have a person throwing a ball. If a person throws a ball, and you have a target, most likely he's going to hit the target and it's going to be roughly around the target, right? If he misses, it's roughly around the target. If he tries to throw a ball and he tries to throw a ball too far, and your target is super far away, it's most likely even a good thrower is going to miss the target. And if he misses, it could be because he's not a good thrower, but also because maybe the wind isn't blowing correctly, or maybe he hit a branch. You introduce just more random things that can happen that make it so that your prediction it doesn't work, because you cannot predict so many external random events happening. And they're not fully random events, it's just things that you can't really take into consideration into your sort of model. So what does that mean? It means that really, if you're trying to predict the exact price of gold 4 months from now with computers, it doesn't work, okay? I think most of you guys know that. But it also tells you something else. It also tells you that if the status quo stays the same, right? Because when I look at how the model works, and when I look at the 14-day model, when the status quo is the same, that means that there is very little external factors impacting the price of gold. It's pretty accurate in terms of projecting. So you have to imagine it like this. Imagine that, how it's trying to predict gold is in a controlled environment, in a training environment. It's like, instead of being in a match with your pitcher 14 days away from the match, you're imagining that your pitcher is pitching the same during the match as he was pitching during your training session. That's exactly what you're saying. You're saying that, look, if my pitcher didn't have a hand broken and he's pitching at a training session, he's knocking out half the team, but and in 14 days he's going to go into that match. If he pitches then, he would do so well against that other team, right? He might eliminate, like, because that team is bad, he might eliminate 80% of it. Maybe that team is good, he'll only eliminate like 40% of them. That's how the model works. And it gives you some guidance. It's not like going to tell you like it's exactly going to be like, drive the price of gold up, or it's going to drive the price of gold down, or there will be a confirmed bear market or bull market. What it tells you is, for example, if I look at the predicted price of gold from today, right? The predicted price of gold is, there's a lot of information. Scroll up. The predicted price of gold from today, that is the 20th of November, is lower than what the price is of today. It's almost 10% lower. And I think there's a reason for that, why the model is doing this. And I'm going to try and explain it. So if we think about all the current factors, right? What has happened over the last few days? Well, over the last few days, the price of the US 10-year Treasury note has increased, right? The Federal Reserve wanted to fix it at 0.35. Right now, it's closer to 0.8 something. This means that potentially there's no stimulus, right? We don't have stimulus right now. We know that Steve Mnuchin took away a lot of the tools that the Federal Reserve could use to inject money into the economy. We know that those tools have been gone. They've been priced out of the model. If you look at the prices before the current date, they were slightly higher. Like if we were making the projections from October, knowing the current market information, the prices, they were not so much higher, but they were slightly higher going into next year, 4 months from now. But from today, we can see that the prices have drastically decreased in the projected prices for the future. And that is because things changed. The interest rate went up. The stock market is not crashing. And also, there is probably more certainty. There's a vaccine. The election risk has been priced out of the general market. People sort of expect Biden. You can be either side of the political spectrum, but the markets seem to have priced in that Biden has won, right? I'm not saying that like whoever, I can't tell them what will happen in like coming next year, but the markets have priced in that Biden have won based upon the current information. This is what the markets are doing. I'm not telling you what will happen. I'm telling you what the markets see as happening. And this is also what happens in the 14 days, right? We can see that right now, specifically at this moment, right? The last time I ran this was on the 20th, which was Friday. We pretty much had a status quo. Not much has changed, right? In the short term. That means in the short term, interest rates, yes, they went up a little bit, and but overall, we're in a status quo. And if we look at how like the price of gold is being predicted, it's been predicted that we are sort of in a flat trend. There's not too much that's going to happen. And I think this is pretty accurate, is that if I look at what the model is telling me, right? I'm not saying that the price of gold is going to be 1900 in 14 days. I'm saying that the longer term model is saying that based on current factors, we are going to see a downward trend in the price of gold because interest rates are up, the markets are liquid, all of the different aspects of the markets that it learned about is pretty much conducive to downward pressure for the price of gold in 4 months. This is not an evolution of price. It's like minus 10% in 4 months. So that's like 2% per month. It's a very, very slow bear market, right? It's saying that like there are a lot of factors that are weakly driving the price of gold downwards, right? Keep that in mind. And what the shorter term sort of model is saying that in the short term, there is nothing that is going to indicate within the next 2 weeks, there's going to be so much of a change in the price of gold. And if we look at the price of gold and we do like some basic technical analysis, we can see that there's sort of a testing of the bottom of gold prices around, I would say, 1850. And there is a sort of downward trend. So potentially what we're seeing is that gold is just going to trade sideways. It's going to be a very, very slow sort of downward trend as gold moves across the year until 2021. I don't think we'll see a crash in the price of gold. There's nothing indicating that, all of a sudden, what could cause the crash of the price of gold? Well, if interest rates, for example, right now, which the 10-year interest rate is at 0.83, I think, shoots up to like 5%, then you can expect a strong correction in the price of gold. You will also expect a strong correction in the price of, at least in the short term, for monetary supply and everything, the tighten monetary supply. You will see a stronger dollar because the futures market for the dollar is also affected by the interest rate, the long-term interest rate of the dollar. And yeah, that's going to cause a weakening of the price of gold. But we don't think that's going to happen for the end of the year because, typically nothing really happens in the month of December. You don't really have crashes in the month of December. There's no real policy decision that's taken. There's very few results that's released. Markets around Europe, most of them, they're just quiet. They trend downwards and slowly. And it's usually around April, March that things reopen and, you see some movement and volatility here and there. Winter is slow for everything, pretty much. And I think it's very normal that gold is not like rushing to the 2000s level. Now, I do think that, if you go back to in this year, I have the historical prices. If we go back to, let's say we make the 4-month prediction and we are going back to when it predicted for, when it predicted gold near 2000, it was around, yes, here we are. We are in July, okay? In July, we had predictions of $2,000 gold. And if you remember, back in July, when gold started moving upwards because of QE, right? It was after mid-July. A lot of analysts were coming out of their closet and saying, look, we're expecting $2,000 plus gold. And if I look at the machine learning model and how it's making its predictions based upon all current sort of what was known in July about what the Fed is doing and what the markets were doing and the pandemic situation in July and the overall economic situation in July, $2,000 gold was probably a realistic guess back then. What they didn't know was when the vaccine would come out, right? They didn't know that. They didn't know that, for example, there would be no stimulus. They might have expected more stimulus. They might have expected, maybe it's very rare for a president to only do a 4-year term, actually. Most presidents do an 8-year term, so they're saying that Trump would have won the election. There will not be a contested election that is currently in place. And basically him and Senate would agree on a massive stimulus package that would go forward and we would have stimulus and everything will conform to how things should be and we will see $2,000 gold. Well, none of that happened. Everything shifted. But interest rates started going up. Interest rates right now are at 0.83%, which is still low. It's very low, but it is not negative interest rates. It's not negative interest rates. And which means that if you run the model today to predict what might happen in the future, it means that, let's say today it looks at the interest rate and says, okay, the current interest rate and the day before that has been rising. So if we assume that we're in a rising interest rate environment, and we are in a sort of bullish stock environment, and we have very cheap pricing on options for bear markets, then we can assume that the price of gold is going to go down. That's a very reasonable expectation. And if you're doing fundamental analysis, you'll be like, yeah, that would be a good expectation. However, it cannot take into the fact that there has been an election in January. There will be policy changes, right? And there is a current struggle in the government for who decides what is the economic policy. So that's why these models, they are unable to predict changes in the basic factors that can shift. If it's gradual changes due to market conditions, it can adjust itself, but sudden changes due to policy or due to external shock or due to, I don't know, if in 112 days there's a meteor that falls out of the sky with nuggets, gold nuggets, and lands in the middle of Earth, the ocean, and people start mining gold nuggets and increase supply. It can't predict that. It can't predict that. It can't predict the pandemic. It cannot be in there. It can't predict who will have control of the Senate in January in the runoff elections. It can't predict the results of the Trump's, the contested election. It cannot predict these things, and it cannot work it just can't, depending on what is the outcome of that. When you run the model based upon the new information and when all the markets have adjusted, it can make you a new prediction, right? So that is the limitation, but it is a useful tool to know that if the status quo is maintained, right, you can expect $1,600 gold. And it's also important to know that, for example, right now we can expect the status quo at least until December, so the 14-day model should be relatively accurate. We shouldn't see lower than $1,800 gold, but we shouldn't see $2,000 gold either. It will be somewhere between there. It will be probably if I take this prediction, that means the average in this area, we should see somewhere around 1878. That will be the average price in this area until beginning December, and I'll run it tomorrow morning, but roughly we'll see somewhere around the 1870 range, most likely. 1870, 1860, 1850, 1890, somewhere between 1850 and 1900. But beneath 1900, it's very unlikely it'll stay a long time above 1900. Which is kind of sort of the status quo. People are buying and selling gold and waiting for what's going to happen next. That's kind of the situation we're in. And that's what the model is telling me, at least, is going to happen. And when I look at the technical analysis, the graphs, I see that every time it's going to oversold territory, it bounces back up to the normal territory. It goes back down to the oversold territory. It goes above the overbought territory. It goes down to oversold. It goes above overbought. So people are buying and selling gold before the end of the year, and it's not going anywhere because there's nothing to change really the price that is currently at. If let's say interest rates go up, right, most likely the price of gold will go down. If interest rates go down, the price of gold will go up. If overall the markets panic before the end of the year, there's a liquidity crisis in the stock market, most likely in the short term, gold will go down and then it will go up as liquidity goes up. But right now, we don't know which one of those things is going to happen. That's the thing. This is sort of the short term. What about long term? Well, if you're stacking 30 years, what should you do right now? I think actually it's quite safe to even wait a bit before buying more physical gold. That's, I think, what I will do. I'm going to still buy physical gold and physical silver in the form of bars, coins, and so on. But I can choose to do it slowly because potentially I see lower prices, which means that I can stack more. And so being able to stack more is always a good thing. If I expect that there potentially is lower prices and I already have a decent stack, I don't see why I can't wait a little bit and save a little bit of money. That's what most likely I'm gonna keep stacking. I don't know who's going to win the election. I mean, if you look at the actual movement of gold and silver relative to the market, I mean, I have the actual price here from a long time ago, but where is this? This is gold, silver, 14 days. We're looking at the 112 days over the period of all these years. And realized gold, you can see it's pretty much flat. I mean, it trades within a $500 band and it just stays flat, more or less. And it doesn't do very much. I mean, even if I decrease the size of this, you can see that we were pretty much in sort of a 4-year glut, and it didn't move very much, and it just is flat for a long time, and then it started moving back up a little bit, and then pretty much gold is not, if you put the S&P 500 next to this, the S&P 500 will be much more volatile than what gold does, especially in day-to-day. So what will I be doing next with my gold sack? I'm gonna wait a little bit, and then if the price goes down to 1,500, 1,600, I'll pick up more. It just means that I can buy more gold. And that's how it works. And yeah, does it mean that you should stop buying gold? I'm not saying stop buying gold. I'm saying, you know, potentially we're going to see like we're going to see lower prices in the future, right? But we're not going to see zero prices. We're going to see a downward trend in terms of the prices. And you have to remember, it's better if you take like an average. If I take the average in this period, it thinks that it's around 1,600 in February. If I take the average in, let's see, let me take the average from this area. Okay, in January, February, most likely we will see 1,700 ranges, 1,750, which is funny. Because there was an analyst that said that we potentially could see 1,700 price of gold. Look, I think that potentially we might see 1,700 if for example, if this is a case where we could see 1,700 price of gold. If there's no stimulus, that means that stimulus is in deadlock. If the markets, let's say the Federal Reserve wants to do QE, but the Treasury does not cooperate, and we have no possibility of QE, and there's no bailout for small businesses, and there's no bailout for the American citizens, we could see a downward trend in gold. You're like, yeah, but why is that? Why? I mean, this is short term, right? We will see a downward trend in the short term for the price of gold. And one of the reasons for that is because the overall dollar will, well, in the short term, when you have a crisis, the dollar gets stronger. People don't want assets. Most likely, if that happens, let's say there's no bailout by February next year, and if by February, for example, Republicans decide to fight Biden's nomination as the president, and then they try to like defer it and then have it delayed an extra like 14 days and an extra 14 days, then you don't have a president in the government. I mean, it doesn't matter who's the president, there just isn't one, and then it's going to be delayed, and that will cause more turmoil, and in the short term, it's going to strengthen the dollar. And if it strengthens the dollar, and let's say the dollar gets stronger, interest rates go up because there's no QE, there is a credit crisis, the first thing you'll see is a downward trend in the price of gold. And I think this is kind of an interesting indicator, because I think at least in September, there was sort of a sentiment, at least beginning September, October, that there will be QE, right? If I look at what happened in October and even the beginning of November, people were expecting QE, stimulus, and so on. And so the price of gold was in the range of 1900s and so on. But, and at least from the predictor, which bases itself on the prices of all other assets in the economy. But when those assets have been repriced, and we know that there probably won't be stimulus, you can see that the predicted price just tanks. It just, because there is no stimulus, it's very hard for gold to maintain its current price levels. That's what I'm saying. Does it mean that gold doesn't have value and gold depends on stimulus? No, gold's value is relative to the value of the dollar. And if the value, imagine this, right? I feature a lot of old coins in my videos, and I feature like the 20 franc coin. And imagine this: 20 francs, French francs in the 1900s, in the early 1900s, is worth 320 Swiss francs today because they're the same unit. And the French franc is, I think, 0.46 euros. So it's roughly like half a Swiss franc, 0.046 because 0.46. So essentially the French franc, if you were to convert that franc to today's French franc, which doesn't exist anymore, it would be around it'd be 800, almost 1,000 French francs today. Now, how do you go from 20 French francs to 1,000 French francs? Well, you devalue your currency, and then you adopt the euro, and then you have no currency, and yeah, that's how you do it. Even in Swiss francs, 20 Swiss francs today is 300 Swiss francs. If you go by the price of gold, it's a huge change. It's more than 10x change over the period of the 20 Swiss franc. The oldest, the newest one I have is 1949. So over a period of 60 years, it increased by over 10%. So that shows you that, like, if you devalue your currency relative to a supranational currency, essentially, the value of that currency goes up. Do I think that if you don't depreciate it in the short term, it'll go down? Yeah, if you don't sell, like, if there's no QE, the price of gold is going to stay roughly the same range. It's going to stay within the 1800, below 1800, and above 1600. It's still higher than before higher than last year, but it's because they did one session of QE, but the current price of gold also prices in sort of, it's midway expecting that there will be another session of QE. In the future, there might be a third session of QE to get the economy out of the dark pit. And right now, it seems like it's unlikely to happen, at least in the short term. I don't know what might happen in the long term. Like I said, the model, it can't predict. Like, if I show you the times it fails, it cannot predict things that it doesn't know about or it can't look at. For example, shutdowns, and also here you have this massive drop, which is when the QE comes and the prices rise, or this is more like unexpected QE, right? People were not expecting the Fed to step in July to say we're going to do so much QE, like a few $1 trillion worth of QE. And also here, like, I think there's a pricing that it could not predict that Mnuchin would decide that, the Fed, you can't have QE anymore. So I think that, there are points where there are things that it cannot predict. It just can't predict a lot of external factors until it prices it in, and then it gives you a new normal. And then it goes back to normal. If you look at the graph, that's kind of what it does. When QE starts, the markets have not yet adjusted. I mean, people like to think markets are perfectly inefficient, but they're not. And there is always a little bit of lag. It's not much of a lag, it does it over 1 or 2 days. All the markets start getting updated. But yeah, and then once it updates, it starts moving into this new normal. Also in March, it made wrong predictions. It predicted a much bigger drop than actually what dropped. And you can see it here that it predicted a huge drop in prices, but actually there was not such a huge drop. There was just a little bit of a drop, and then gold remained strong, and the model also adjusted to the new normal once all the other factors have adjusted too. Is this model useful? I think one of the things you should look for is when the predicted price and the realized price diverge too much, right? When you look at this prediction, when it's above 90%, it's not very interesting. Like, the price of gold is going to go like the price of gold in this case. But when the price sort of diverges a lot in the 14 days, it means that some external factor is changing how gold will behave. And if it's trending upwards during this period of divergence, it means that you're going into a strong bull run due to an external factor. And if it's like sort of crossing, right, and the price drops below a certain amount, it means that there is a negative external factor that the model cannot predict. For example, a hike in interest rates. It can't predict that. It cannot predict a decision to hike interest rates because it's not part of its learning process. You would have to, it just can't learn how hiking. You would have to use a much more powerful learning method. I think you can use neural networks to learn about how it can base its predictions upon predictions of interest rate predictions. But that's not even reliable because interest rates, how they decide is almost a sudden change. It's not like there's a gradual change. It's policy rather than markets, which is some people think it's good, some people think it's bad. It's just that it's outside of any sort of model that you can run and you can base your machine upon, unless it decides to teach your machine to read the news. That's another whole area. So does it work in predicting gold? No, it doesn't work in predicting the exact price of gold. It's not, for longer periods, it's not very accurate. I think the average accuracy for a longer period is only 86%, which is very terrible because it could go both ways of a prediction. It can be it can go, so you can't really, it's not great, but it gives you an idea that, that certain fundamental aspects, like if it diverges too much from the model, have changed, which means that you can use it to reassess how the markets, the fundamental aspects of the market, such as interest rates, employment, economic fact indicators, and it's sort of like an early warning flag. Do I think we are going to a bear market? If we are on the same current path that we are, I think we are going into a bear market. Everything points to a bear market, despite the fact that, if you look at the daily indicators, it's kind of in saying that we are being oversold currently. However, we are also not going to shoot up in price unless there is something like stimulus, which is an external factor to drive the price up. I think gold is just going to move sideways and slightly downwards until like 1800, 1780, beginning of the next year. And once all the government's stuff is sorted out, and they decide to do like stimulus or not stimulus or however much stimulus, then maybe we'll see the price of gold go up. The other case where the price of gold can go up is it's not a very nice scenario, is if there is a large-scale conflict in the United States. For example, in January, there is riots because of the finalized results, and then Congress and Senate, decides that they have it's a 50-50 split between Democrats and Republicans, and the RNC decides to support Trump's contest for the presidency, and then starts driving up sort of a civil war to try and maintain power, or at least destabilize a Biden presidency. Then you could probably see the price of gold rise, not because of QE or economic factors, but because people are buying it to hedge against uncertainty. That could happen. But otherwise, I don't know. It's not a crystal ball. It just says that, if everything stays as a status quo, I think at least until January 2021, we're going to not see too much of a movement in the price of gold. We're just going to trade sideways and slightly downwards. We'll probably test the 1800 levels by January. And it's probably not the news that everybody wants to hear. Everyone wants to hear gold goes to the moon. But like I said, it's only in the recent last year that we saw gold move up so quickly. If you bought gold or silver in the past, like when it was still like $12, $17, it doesn't move. It just like stays around that level until something bad happens, you know? That's what it does. Like gold, silver, you know, it just stays flat for a long time, and then something bad happens. It reaches a high and it hits a new level, and then it flattens out at that level. And then it just like, it's like stairs, you know, it moves like stairs. That's the best way I can put it. It's like, if nothing bad happens, it just like goes downwards a little bit for a long time, and then something bad happens, it shoots up. Yeah. Anyways, that's today's analysis. I will be sharing this the outputs from the machine learning algorithm, and I'll be updating it with daily information every time I run. I'll run it probably once every single day. It'll be for me, but also I'll share with you guys so you can see what it's trying to predict and what it's trying to read. And stay tuned for daily content, because I mean, you have to keep this in mind. This isn't what the price of gold will be in the future, right? You just have to know that this is not the price of gold in the future. It's a sort of a prediction of what might happen. It's not the exact price of gold in the future. You can't say like, oh, you know, your model said like it would be what did it say here? It will be 1690, and it's not. Don't go out and buy gold based upon the information in this chart. I'm telling you, the chart cannot predict the exact price of gold, nor does it even predict. Sometimes it gets it completely wrong. It cannot take into account, like, it can be wrong. The chart can be wrong. And it cannot take into account external factors. It's not 100% accurate. It's not like, I don't have a fiduciary duty. I'm not a certified bank or an analyst, but I'm sharing my findings and what I'm going to be doing for myself. But this is not a guarantee. There's no guarantee that it's going to work, right? This is an experiment, and I'm sharing with you, and you can join me along with this experiment or not and see what I'm doing. But don't base your future life savings on this. And like I always say, don't go in too heavy on gold. It's an insurance, or a silver. It's an insurance. Just cost average a little bit every single month, and it goes up over time. Over a long period of time, it tends to go up. So yeah, that's all I wanted to talk about today. Thank you for watching. Click the like button, subscribe for daily content, and thank you very much for watching. Dave out.